The first type of adjusting entry is what's called an accrual. And the second type is called a deferral. Can anybody give me a definition of those words? Like, just like, what does it mean to accrue something, or what does it mean to defer something? Those are words we don't use a lot anyway. Do you know what it means to accrue? Okay. He says to gain. So yeah, when we accrue something, it means we gain or something over time, usually, right? When someone says like he's accrued wealth, it means he's like saved up a lot wealth over his lifetime. So accruals have to do with bringing things in, okay? And then defer something means to put it off to the future, right? When we say we deferred, like in the military, they say you have a deferred enlistment, right? Deferred enlistments, which means you sign up now, but you're not going into the military until some point in the future, right? All right. So an accrual occurs when a revenue has been earned or an expense has been incurred, but has not been recorded. Okay. So we're accruing this, which means we are gaining this revenue or expense, but it hasn't been recorded. And I'll give you some examples in a minute. Just remember that definition. So an accrual for a revenue, our adjusting entry, well, I'll go over these adjusting entries in a little while. So here's the idea. You'll see in that first, so the first little T account shows the initial recording. Everybody see that, what I'm talking about? And then to the right of it is its end of period adjustment. So here's what happens. When we accrue revenue, we've earned revenue, but no journal entry has been made. This happens in a lot of businesses, especially businesses that bill for time. So attorneys, CPAs. What happens is, as we do work for our customers or our clients, we're earning revenue because we're doing work for them. But then usually we just wait till the end of the month, and then we sort of tally up all the work we did for them. And at that point, we bill them. Okay. So remember, we work in periods of time. Accounting is periodic. So in order for me to have the correct revenue showing on my income statement at the end of the month, and the correct assets and liabilities and equity, I need to go ahead and record anything I've earned during the month at the end of the month if I haven't yet recorded it. So if I did work for you all month and I don't record that, then my numbers are going to be off, right? I'm not going to show all the revenue I've earned. Or if I've incurred expenses all month but haven't recorded those. So what you normally do is at the end of the month, you do what's called an adjusting entry. Okay, that's this whole chapter is on adjusting entries to show that we have earned that revenue, or we've earned that revenue. So for an accrual, so for an accrued revenue, our adjusting entry at the end of the month is going to be to record the revenue and to record that we haven't received it yet. So it's always going to look like this: accounts receivable, and whatever the revenue account is. Okay, I'm just going to call it revenue earned. So there's our first type of adjusting entry. Accrued revenue means we've earned revenue, but we have not yet recorded it. So we do an adjustment at the end of the month to show that we have earned it. So we credit revenue and that it's owed to us. We debit accounts receivable. Okay, so that's the adjusting entry for accrued revenue transactions. And remember that an accrued revenue transaction is a transaction where we've earned the revenue, but have not yet been paid for it and have not yet even recorded it. Okay, very common in a lot of businesses, even in like construction businesses. A lot of times, they'll do work for people and then just bill them at the end of the month. Okay, it's really a normal thing to do. Okay, so that's right. So the adjusting entries. Here's a couple rules that might help you. Adjusting entries always occur at the end of the month. They're always entered on the last day of the month to make any adjustments for, like in this case, revenue that was earned but has not yet been recorded. Okay. The other thing is adjusting entries never involve cash, ever. Okay. Because remember, all of these arise from the fact that we either did work without cash or we got cash in advance. But the adjustment is to show how we've either earned the revenue or how, it's always to deal with revenue or expenses, not to deal with the cash part of it, which is an interesting thing to get used to. So that's an accrued revenue. The adjusting entry always looks like that. Accounts receivable, debit, revenue earned, credit, every time. Okay. The revenue earned might be called something different depending on the business you're dealing with, right? It could be fees earned, it could be rental revenue, it could be lots of different names for the rent or for the revenue account, but that's how the accrued revenue works. The second one we have down below there, it says accrued expense. So this is where an expense has been incurred, but no journal entry has been made. So sometimes people deliver goods or things to us, but we don't record them. At the end of the month, we go ahead and record that so that our books will correctly show, and our statements, our income statement will correctly show all of the expenses for that month, okay? And so again, it's gonna look like this. So here's an accrued expense. It's gonna have the expense, whatever it is, on the debit, and then it's gonna have the account payable on the credit. So this is recognizing some sort of expense that we've incurred. A very common one, if you think about it, is our employees are working all the time. Now, here at the college, we're all working, doing our job, but we don't get paid till payday, okay? So at the end of the month, we might find that our employees have worked so many hours this week, but we're not actually going to pay them until next Friday or whatever, which is payday. So again, we would have to do an adjusting entry to recognize that we've incurred a salary and wage expense, but we haven't paid it yet. So we'd probably call it salaries and wages payable. Then on the next payday, we'd pay them and we get rid of that payable and we'd be good. Again, so the whole intent of these is so that our books are accurate for the end of the month, so we can do our end of the month reporting. So we can report our revenues and expenses, even if we haven't yet paid them or yet received the money. Okay, that's the whole purpose of accruals. All right, the second type are called deferrals. So remember, the idea of a deferral is putting something off to the future. So this happens when we record something, usually like I mentioned, like the unearned revenue, right? So someone gives us money, I've recorded that as a liability, and now I've actually earned some of it during this month. Okay, so what was put off to the future has now come, and I have to record the fact that I've earned it. Okay, that would be like a deferred revenue. So here's what the transactions look like. So with an unearned revenue, they call it, which is a type of deferral. So our initial transaction was that cash has been received for revenue that will be earned in a future period. So the initial recording when someone gives me the cash looks like this. I debit cash, cash goes up. I credit unearned revenue, a liability account, right? That goes up. Then my adjusting entry, my end of period adjustment, is going to be a debit to unearned revenue. Remember, that's a liability account, not a revenue account. And a credit to the revenue account. So think about what that means. It means the liabilities decrease with the debit. So the liability, unearned revenue, is going down and the revenue is going up. So let me talk through one more time what's happening. Think of my storage. Someone comes to me and says, hey, it's $40 a month. Can I just give you $480 for the year? So that way I don't have to worry about it every month. And I say, yes. So when that happens, my initial transaction would be to record cash going up by 480 and unearned revenue going up by 480. In other words, I got cash and I owe it all back to that customer, either in the form of services or in the form of a refund, right? Then at the end of each month, I want to recognize during that month, I earned 1 month's worth of rent, $40 worth. So I'm going to do this adjusting entry, which is going to reduce the unearned revenue by 40 bucks and increase, for my company, it was rental revenue by 40 bucks. So then I do that every month for the next 12 months. And at the end of that 12 months, the unearned revenue account's gone. I no longer have a liability. And in my rental revenue account would have a balance of 480. So in essence, I got the cash here and then earned it at $40 a month over the next 12 months. Okay. So the adjusting entry is my way of reducing the liability and increasing the actual revenue as I earn it. Yeah. Yeah, that's good. So we keep what's called a, just to use another big weird term, we use what's called a subsidiary ledger, which means like a sub account of the account unearned revenue in the name of each customer, or by account number or something like that. Right. Right. Same thing with accounts receivable. You have accounts receivable, you know, the whole amount, but then that's broken down by customer within the accounts receivable. And in your accounts payable account, you might have one accounts payable, but it's broken down by all the different vendors that you owe money to. Yeah, good. That's a good question. All right. So that is a deferred revenue. Our adjusting entry is always going to be a debit to unearned revenue, so decrease the liability, and a credit to revenue, increase the revenue. Okay. And then a deferred expense is one where we have, so we've already seen an example of this in the work we've been doing. A good example would be like supplies. So we record supplies when we buy them, but we don't take the expense, right? We've seen that in the work we've already done. So I buy $1,000 worth of supplies, I debit supplies, I credit cash. That's my initial entry. Then at the end of the period, I count up how much supplies I've used. Usually what I do is count up how much I had there and subtract that from the amount that was the balance, and the difference is the amount I used, right? And then I do an adjusting entry that's going to list debit the expense, and it's going to credit whatever I'm going to call it the prepaid expense. Prepaid expenses are an asset account. So in the case of supplies, our initial entry, increase the asset supplies, decrease our cash, and then our adjustment at the end of each month is to record the expense and reduce the asset. Other forms of prepaid expenses are things like prepaid insurance, prepaid rent, right? Like if my cut, you know, think of how I just described how this works from my side when the customer pays me in advance. Well, from his side, he prepaid $480 or $480. What would that be to him? It's an asset called prepaid rent because he's owed the use of the building for the next 12 months. Okay. Then each month he wants to reduce that asset prepaid rent and record it as an expense because now he's used up a month's worth of that. Okay. So that's the deferred expense. Yeah. If it has prepaid in its name, it's pretty much always an asset. The most common ones you'll see is prepaid insurance. It's really normal for people to pay a whole year's worth of insurance, as an example. Prepaid rent. And then there's the other thing where they're not prepaids, but they're like the purchase of an asset, like supplies. And we'll talk about depreciation here in a minute, which is another kind of confusing thing. So those are our 4 types of adjusting entries: accrued revenues, accrued expenses, deferred revenues, deferred expenses. That's it.